Good afternoon, everyone. Thanks for joining us. We'll get started. It's great to see so many on. We decided to do financial literacy because we know that it's sometimes quite hard and seems like a huge task to understand all the number side of things to do with the business. So a little roadmap that we're going to just cover in the next 30 minutes. We're going to start with understanding the why of why you want to dive deep into the core kind of concepts, making sure that we're all speaking the same language. I want to spend some time looking at the profit versus cash dilemma. And I think that'll be a real game changer, making sure that we're all clear on that. We're going to talk you through how to read the key financial reports, the profit and loss, the balance sheet, and the cash flow, making sure you've got a really good health check for your business. And then we'll just quickly touch on some essential tax obligations for key businesses. And then we'll wrap up with some common mistakes, making sure you've got a real cool action plan. So feel free to ask in the Q&A at the bottom any questions throughout the next 30 minutes, and I will answer them throughout we're going. Otherwise, let's get started. Now, I have two people that will guide you through the series today, Sarah and Tristan. Sarah is one of our fantastic senior accountants, and she is joined by Tristan, who is up and coming. And without further ado, I'll pass you over to Sarah, who's going to get started.
Perfect. Thanks, Brigitte. Welcome, everyone. We're so excited to run through this. So just a quick reminder before we carry on. Yeah, any questions, pop them in the chat box, and we'll try and answer them at the end. So the first thing that we want to get started on is why are we here? So the statistic on this slide here is a bit of a confronting one. It's saying that 80% of business failures are actually linked to poor management. So most businesses don't fail because of poor product. They fail due to bad management, bad financial management. So rather than us seeing this as a warning sign, I encourage you to view it as a powerful opportunity, because this one is one area of your business that you can take full control of. So financial literacy isn't just about bookkeeping, it's about your strategy. It's about understanding your business so thoroughly that you can anticipate changes well before they arrive and confidently steer them around. It's also about recognizing the right moment to launch or grow a new product and backing that decision with solid numbers. It means that when you walk into the bank, you're not just hoping for funding, you're presenting a clear, credible case that improves your chances of success. And ultimately, it's about peace of mind, knowing that you're in control and building something sustainable. Right, so first up, we're going to cover 3 key financial concepts. They lay out the foundation for a successful business. So the first one there is our revenue versus profit. So this is about understanding the difference between what you make and what you get to keep. Number 2 is our fixed versus variable costs. So knowing what these are and knowing what stays the same and what changes as your business grows. And then the last one is our gross profit margin, a simple but powerful tool to measure how efficiently you're running the business. So we'll get straight into it and we'll look at our revenue versus profit. So we're going to build a foundation with a few key terms. So to make smart business decisions, we all need to be speaking the same language. And the two most fundamental words that in this language are revenue and profit. First, we have revenue. Revenue is your turnover. Every single dollar your customers pay you for the goods or services before any costs are taken out. They often call this the top line of your financial statements. So let's imagine we run a small pizza shop. We sell one pizza for $20. That $20 is our revenue for the single transaction. If we sell 100 pizzas in a day, our total revenue is then 100 times the $20, which equals the $2,000. It's a measure of our sales activity, but it's not what we get to take home at the end of the day. Next is our profit. Profit is what you actually get to keep after you've paid for everything else. This is our bottom line figure, and it's the truest measure of your business's financial health. Using our $20 pizza example, let's break down the costs. So we've got costs of ingredients. First, we subtract the direct costs of making the pizza. So that's things like flour, cheese, tomatoes, and let's say those costs $8 per pizza. We then have $20 revenue less the $8 of ingredients, which is then $12. That $12 is called our gross profit. It's what's left over to pay for all our operational expenses. Now, if we carry on down, we have to subtract the costs of running the shop for the day. Things like rent, wages, electricity, insurance, marketing. If we allocate these costs, that's another $4.50 attributed to that pizza. So $12 gross profit, less our $4.50 of our operating costs, is $7.50 net profit. So we sold a pizza for $20, but our actual net profit is only $7.50. So it's vital. This brings me to the next most important point. It's vital to know what both of these are, but we never want to mistake one for the other. Righto, onto our fixed versus variable costs. So now that we've covered revenue and profit, let's look at the other side of the equation, our costs. For any businesses, our costs generally fall into two main buckets, our fixed costs and our variable costs. Our fixed costs, these are the consistent, predictable expenses we have to pay just to open the doors and keep the lights on. These are things like our rent or insurance. We have to pay them whether we sell one item or 1,000, and they don't change depending on the sales volume in the short term. So let's use our pizza example. Our monthly rent is $200. If we have a slow month and only sell 100 pizzas, our rent is still $200 for the month. But if we have a fantastic month and sell 1,000 pizzas, the rent is still going to be $200. The second bucket holds our variable costs. As the name suggests, these costs fluctuate. They are directly tied to the sales volume, like the cost of materials. The more you sell, the more you spend on these items. Back to our pizza restaurant, the cost of flour, cheese, tomatoes, pizza boxes, these are all variable costs. If you sell more pizzas, you need to buy more ingredients, more boxes. If your sales are slow, then you'll spend less on these things. They move in direct line with your production. So you're probably asking, why do we separate these costs? Because understanding this mix is the first step to smart pricing and effective decision making. And then the last thing that I wanted to talk about is our gross profit margin. So now that we have a handle on our costs, let's look at one of the most important metrics, and that's measuring the health of our business using the gross profit margin. The gross profit margin tells us for every dollar of sales, how many cents are left over to pay for our overheads and ultimately then generate a profit. In essence, it measures the profitability of your products and services before you account for your fixed operational costs. It answers the fundamental question, are we making enough money on each sale to sustain the rest of the business? The calculation itself is pretty straightforward. First, you determine your gross profit, which is our revenue less the cost of goods sold. Our cost of goods sold is essentially the total of our variable costs that we just discussed, so our cheese, flour, tomatoes, etc. Then to get to the margin, you express that gross profit as a percentage of your total revenue. So it's gross profit divided by our revenue times 100. So if we go back to our pizza restaurant, we sell a pizza for $20. That's our revenue. The ingredients, so our flour, cheese, toppings, boxes, cost us $8 in total. That's our cost of goods. So our gross profit per pizza is $20 being the revenue, less $8 being the cost of goods sold, which equals $12. Now to find the margin, it would be $12 divided by $20 being our revenue times 100, and that equals 60%. So this means for every dollar we make from selling pizzas, 60 cents of it is available to contribute towards paying your fixed costs like rent, insurance, etc. And what then is left after is your net profit. And the very last topic I wanted to discuss before handing over to Tristan is your break-even point. And this is arguably the most crucial number for managing your business day to day. If you don't know your break-even point, you're basically flying blind. Your break-even point is the level of sales where your total revenue exactly equals your total costs. At this point, your business is not making a profit, but it's also not losing any money. You are quite literally breaking even. Every single sale you make before you hit this point is contributing to pay off your fixed costs, and every single sale you make after you hit this point is profit directly into your pocket. So to find out your break-even point, you'll need the figures we've already discussed, so our costs and our variable costs. The basic formula tells us how many pizzas we need to sell to cover our costs. So our break-even point, which is in the top right of this screen, is our total fixed costs divided by the price per unit costs less our variable costs per unit. The price per unit costs less our variable costs is called our contribution margin, and it's the amount of each sale that contributes towards paying down our fixed costs. So let's apply this to our pizza restaurant. Let's say the total fixed costs, like rent and insurance, etc., are $6,000 per month. The price of one pizza is $20. The variable costs, which are our ingredients, our flour, etc., for one pizza are $8. So our contribution margin per pizza is $20 less the $8, being $12. So we'd put $12 at the bottom of this equation. Now, when we calculate the break-even point, we'd use $6,000 as our fixed costs divided by the $12, which is our contribution margin. Now this equals 500. So this means our restaurant needs to sell 500 pizzas every month just to break even. The 501st pizza we sell is where our profits for the month begin. Right, so I'll hand you over to Tristan now. And just a reminder, if you have any questions on what I've just talked about, then jot them down in the question box and we will answer them at the end.
Awesome. Thank you, Sarah. I'm going to jump into some financial report basics. I'm going to look at 3 financial reports that you would normally see quite often. 2 of them you'll see in your annual accounts every year, and the other one, it's just as important, but sometimes you just need an accountant to help you set it up. So we're going to think of these financial reports as the dashboard of your business. Just like a car shows your speed, your fuel level, and your warning lights, your financial reports show your income, expenses, assets, liabilities, and cash movement. And they can help you spot issues early and make smarter decisions before anything goes off track. Now, these reports are not something we have to be afraid of or avoid. They're there to help you and drive with confidence and stay in control. So the 3 key reports that we think every business owner should know and keep an eye on is the profit and loss statement. This shows how much money you're making or potentially losing over a period of time. The balance sheet is giving you a snapshot of what your business owns and owes at a specific point in time. And the cash flow statement is the actual movement of money in and out of your bank account. Now, we use these reports together to give us a clear, high-level view of what's actually happening across your business and how the different pieces connect. So let's look at the first report, the profit and loss. On the left here, I have a healthy P&L, profit and loss. On the right, I have an unhealthy profit and loss. Now, I like to think of a profit and loss as a scoreboard for your business. It tells how you're performing over a set period of time, whether you're losing or winning the game financially. The sales at the top here are like the number of goals or points that you've scored and tells how much you're bringing in. The expenses are the points the other team has scored, the costs of running the game. The net profit at the bottom, that's the final score. If it's positive, you've come out ahead. But if it's negative, it's probably time to look at the strategy and rethink about it. But just like in a sports game, you don't wait till the end of the season to check the score and how you're doing. You keep an eye on it regularly, maybe monthly, 2-monthly, quarterly, so you can adjust your game plan before it's too late. Just a side note on this profit and loss statement that you'll see in your accounts. This is a scoreboard that runs on accrual accounting. So the points that you get here are counted when they are earned or incurred and not necessarily when the $50,000 cash hits the bank. That's why you also need to look at your cash flow, which we'll look at in the third slide, because in business, it's possible to win on this report, but also lose on the fifth. So if we move on to the balance sheet, this is all about stability. It's the business financial snapshot at one point of a time. Normally for standard balance date, it'll be 31st March is when you'll look at this point in time. So if we look on the left here, we've got a healthy balance sheet example, which shows that you've got good cash reserves, manageable debt, and positive equity at the bottom. This is your net worth as the owner. In contrast, we have an unhealthy balance sheet over here, which has got low cash reserves, but high levels of debt. So you can see that the assets are less than the liabilities, meaning the business owes more than it owns. This is called insolvency. When you have a negative figure there, you're technically insolvent. So reviewing this report monthly can act as an early warning sign and help you spot red flags before they become real problems. If we hop on to this cash flow statement. So the cash flow statement shows how money moves in and out of the business. It highlights its ability to generate cash to cover expenses, investments, and debts that you have. Profit doesn't always mean cash. So we see plenty of businesses showing great profits on paper, but they're struggling to pay their bills. Why? Because profit, that's an accounting number, an accrual number, and it includes things like invoices you've sent, but maybe the customer hasn't paid you for. So yes, it might be profitable, but it doesn't help if your rent is due today and the cash hasn't actually hit your bank. Cash is what keeps the business alive. It's the money in the bank account and not just the numbers on a report. That's why managing your cash flow and looking at this report is really important. And so we're going to look at this cash flow on the left again. We have a healthy cash flow in green and an unhealthy cash flow. So in month one, the business had a positive net cash flow of $1,000. We're getting an inflow of $25,000 and our outflow is 24, giving us a net cash of 1,000. And we had 5,000 in the bank to start with. So at the end of month one, we're doing well. We got $6,000. But if we look at month two, we're getting less inflows, but our outflows have stayed the same. So we are now in a negative cash flow. This may be because maybe our receipts from our customers, they've dropped. So we've invoiced people, our profit is up, but we haven't actually received the money. Yet we're still got to pay all our suppliers and our rent, putting us in a negative cash position. So even if your profit and loss looks positive, cash flows can cause issues. And if you're feeling issues with cash flows, it might be really important to start looking at your cash flow statement and actually tracking that regularly. So that finishes up the financial reports. I'm going to hand you over to Sarah again, and she's going to talk about some tax basics for New Zealand small businesses. Here we go.
Awesome. Thanks, Tristan. So we're just going to touch now on, some tax basics. So first of all, record keeping, it's not optional. Unfortunately, the IRD requires us all to keep our business records for 7 years. So you can keep your records digitally. That's completely acceptable as long as they're clear and accessible. Good records aren't just for organisation. They are your best defence if you ever get audited, and they'll make sure you are able to claim every deduction that you're entitled to. Secondly, your first year of business is not tax-free. We hear that so often. You will owe tax on any profits you make, and the bill usually arrives the following April. This catches a lot of new business owners off guard because they don't set that money aside during their first year. And then provisional tax. So starting from your second year, if your tax bill from that first year is more than $5,000, the IRD will then ask you to pay your tax in instalments throughout the year, typically in August, January, and May if you have a standard March balance date. So this is why it's crucial to get into the habit of putting money aside for tax right from day one. Maybe consider setting up a new tax savings account. So you'll also be maybe wondering, how do we pull this all together? So first we start with pricing. Stop guessing. Build your prices based on your actual costs and make sure you include a profit margin. Your profits should be part of a plan, not something that just happens by chance. And then secondly, creating a budget or forecast. It doesn't have to be complicated or technical. Simply take your last 6 months of actual data and project it forward. That one simple habit can make a huge difference in how you manage your cash flow. And on that, we're actually hosting another webinar in September all about budgeting. So we'll dive deeper into the topic and provide you with a handy template to get you started on that as well. And then moving on to our top 5 mistakes. So we see this again and again. And the good news is that every single one of these is avoidable if we apply the principles that we've talked about today. So cash flow, it is the life of your business. Even profitable businesses can fail if they run out of cash to pay bills, wages, suppliers, etc. Don't wait for a crisis to check your cash flow. Monitor it regularly with a simple forecast so you can spot and manage potential shortfalls early. It's common to feel overwhelmed by all these numbers, but ignoring your financial reports is a dangerous habit. Your profit and loss, balance sheet, and cash flow statements are all tools, and they give you insights into what's working and what's potentially not. Regularly reviewing these reports helps you make informed decisions, catch problems early, and grow your business confidently. Competing on price alone can hurt your profits and business sustainability. Many business owners underestimate their costs or forget to include their time, overheads, and a profit margin when setting the price. Build your prices based on your actual costs and desired profit, not just what your competitors are charging. And then lastly, tax bills can sneak up on you if you don't plan ahead. So remember that your first year in business is not tax-free. You will owe tax on the profits you've made, just at a later date. Then from year 2, you will have provisional tax, which means paying in installments during the year, not just once. So start setting money aside from day 1 to avoid those stressful tax surprises. Now I'll hand you back over to Tristan now.
Awesome. Thank you, Sarah. I'm just going to bring up the Q&A. I see that we have 2 questions there. So please pop any questions in the Q&A. We'll be able to see them and then we'll be able to give you some answers. But we've got 2 currently coming from Mike. And he is asking, on the balance sheet, does the equipment refer to plant and equipment or just stock?
Hi, Mark, it's Brigitte. On the balance sheet, there can be both. I would suggest that you would have both split out. So usually property, plant and equipment, so land, buildings, motor vehicles is all in one code, and then and that's usually sitting as a non-current asset. So non-current asset means that it's going to be around for more than 1 year. Current asset or current liability are usually within that 12 months. So inventory obviously changes quite a bit, or stock on hand. So that usually sits in the current asset part. Hopefully that answered that one. The second question there, also on the balance sheet, is the owner's capital and an amount the owner has to put into the business, or has something that has been taken out. So owner's capital, depending on if it's a company structure, you will have it either sitting up in the current assets or a current liability. And that depends whether the owners have taken out money or have put in more money. So it could be overdrawn or it could be in funds. And that's usually supplemented by in a company, you would have a shareholders current account page, which would kind of go further into detail on that. But it's a little bit different with a sole trader. Usually at the bottom, they just have a owner's capital, and that's what they've put in. Yeah. Hopefully that answers that one. Was there any others there, Tristan?
I'm just having a look. So I'm just going to see. Okay, so I've got one here. Someone is asking, they understand the difference between profit and cash, but is it normal for my business to be profitable, but I'm still having cash flow problems?
Perfect. Well, I'll take that one, Brigitte. So short answer, yes, it is common. Profit is an accounting calculation, and it includes non-cash items like our depreciation, sales that haven't been paid yet, our debtors, etc. Whereas cash, on the other hand, is actual money that's come in and out of our bank account that we use to pay our bills, our wages, etc. So a business can have strong sales, which would lead to a high profit. But if your customers are maybe slow to pay, or you have high expenses for stock or equipment purchases, your cash balance can still be low. Hopefully that answers that question.
Awesome. Yeah, Mike's actually, he said thanks, so thanks for responding to that one. I've got one last question here, and then I'll see if there's any other one, but I can see that you mentioned that I should regularly track my profit and loss. How do I actually do that?
Okay, so a profit and loss statement shows our business performance. So to track it, you can get in touch with us, and we can set up a custom report for you in Xero or your accounting software, and we can help you track it each month or period specific to your business, I think would be the most handy.
Cool.
Perfect.
I've actually got another one coming again. So we've got Tracy asking, where does team training or CPD fall? Would this be costed against a service somehow, or worked into fixed yearly costs?
Hi, Tracy. That would be part of the, not to do with the variable cost. That would be more of a fixed cost down under operating costs, which we would usually code under that gross profit line, because there's always an aspect, usually for some particular business, that training is involved every year. If you took an accounting firm, for say, we would have that under the gross profit line. We'll have our sales and our revenue, and then we would have our direct costs being wages, and then we'd have our gross profit, and then our costs that drive the business, regardless how much income I had earned or not. So it would be a cost under that gross profit line. Hopefully that answers that one, Tracy. Anything else? Anyone else got anything there? We're just about at our 30 minutes. We wanted to keep these short and sweet for everyone. So thank you to Sarah and Tristan. That was great. And thank you to everyone that has joined us today and investing your time in learning. Hopefully you've got some tools out of that to tell the difference between revenue and profit. You can also spot the difference between fixed and variable costs in your 3 reports that we highlighted today. And hopefully that magic break-even number is something that we could potentially assist to help out if you're unsure about how to work that a little bit further out. So next session, we are doing one next month on the 18th of September. We're going to try at 4 o'clock. So pop that into your calendar if budgets and forecasts are something that of interest. So basically trying to create a game plan for your money so you can plan for growth. So yeah, thank you for coming along today. Any questions, just feel free to email any of us if you've got anything you want to go over individually. So thank you again.
Awesome.
See ya.
So yeah.